Audits can be very frightening. For a lot of people, that's the case because there's so many myths and misunderstanding about what triggers and what does not trigger an IRS audit. There are some people who think, you know what, if I claim the home office deduction, I am gonna be in an audit, or if I just could make below $100,000, then I will be in a safe spot. Well, that's not the case. So what we're gonna be covering today is what triggers and what does not trigger an IRS audit, just so you don't have to walk around with the inks of anxiety because you're wondering because of what someone said. All right, so to kick things off, I want us to understand first what is an IRS audit, what you can expect based on what they're looking for versus what you presented to them. So an IRS audit is pretty much the IRS examining your tax return because they have seen some level of inconsistency or abnormality. So that could be inconsistency in income or abnormality in your deductions. So they're checking for accuracy purposes. They want to make sure. So there are three main types of IRS audits. You will have your correspondent audits, which is to say the IRS will send you a letter in the mail, and that's how they conduct the audit. The second is oftentimes the office audit, which is when the IRS says, hey, come on down to our office and bring these items based on the nature of your audit. Okay, and usually whatever you're bringing is for support purposes or verification purposes, right? And then the last one here is if it's a field audit. The field audit says the IRS may very well invite themselves to come on down to your home or your business based on the nature of the audit because they want to double check certain things. Okay, so now that we've covered that, let's actually talk about what triggers an IRS audit. There are 6 items that I'll be talking about today. And the first is mismatched income. Now, the IRS system generally has most of your income already in their system, right? Now they're waiting for you to report it on your tax return so that it can reconcile. For example, your W-2, the IRS already has a copy of it. You have a copy, you file the tax return, reconciles. It should be perfect, down to the penny. However, if it gets to the point where these are not the same, then the IRS is like, wait a minute, what's going on here? We want to know what's going on. And this is oftentimes the case with things like 1099 miscellaneous or 1099 NECs, where you as a taxpayer, you may have your 1099 that says $50,000, but the IRS has something different in their system. They want to know why, or it could be the case they have $50,000 and you've reported $40,000 on your tax return. Okay, and there are instances in the past where folks forgot that they sold some stocks, right, to those 1099Bs, and they don't put it on the tax return. The IRS is like, wait a minute, we're seeing some differences here. We're making an adjustment, so you need to approve or you need to agree or disagree based on the adjustments that are being made here, and that's what they would send in a notice. So even if you unintentionally forget, it will still raise a red flag because the IRS is not so forgetful, okay? All right, so the second piece here is if you have extremely high deductions. So extremely high deductions in comparison to your income. So a lot of times the IRS is looking at, hey, how much did you bring in versus your expenses? So if you have $40,000 in income, but you have $30,000 in deduction, statistically, that's not usually the case, right? And common high-risk deductions are things like charitable contribution. If you made donations somewhere, you don't want to overstate that, right? If you're using your vehicle 100% for business, they may want substantiation from that. For example, mileage log, or just some type of record. And then of course, if you have heavy business expenses, for example, if one expense area is overstated or it seems inflated, they want to really know what's going on. Now, the third one here is if you continuously claim a business loss year after year. The general rule of thumb is if after year 3, if you've claimed an expense 3 consecutive years, it's likely that the IRS is going to ask some questions. Now, that's not to say you can't legitimately have these expenses, but it's also to say you need to ensure that you're keeping a copy of all your expenses, right? Making sure that you have proof in the event the IRS says, hey, I need to see what's going on. All right. And even with that loss situation, the IRS is looking to see, well, is this a business or is this a hobby? They always want to double check, especially if you seem to be getting such great benefits from having your losses, right? Now, the next piece or the fourth one would be large cash transaction. So this is more so industry based. So you're looking at laundromats, you're looking at salons, you're looking at restaurants, those industries that have a lot more cash moving around in the business. They tend to be audited more because they don't always reflect all of their cash as income. So when the IRS comes in, they're like, you know what, we just want to double check. And one other thing to note is the IRS has a system based on industry. So they may say, hey, you're the laundromat business. Based on your industry, this is oftentimes the average income that comes in. Why is yours so much lower and you're so much in the average of what it should be, right? And then the fifth one here is the earned income tax credit. This credit is fully refundable. So this is not something that the IRS is playing about. They want to make sure that you're actually eligible for this. The children that you're claiming, your actual income, everything on there. This is where the IRS is like, okay, I'm giving you money. I need to make sure that you, the individual that's getting the money, is actually eligible for it. All right, and then number 6 is generally going to be when folks are taking early retirement distribution without properly reporting it to get penalties and things of that sort. That usually raise red flags. So if you're taking out your distribution from your retirement early and you are putting that you're excluded, the IRS may wonder, well, why is that the case, right? Especially if this is not your first time doing it. All right, so we've talked about those 6 components that could likely trigger an audit. Now let's focus on those that generally they're not the reason why an audit has been triggered. The first one is claiming the home office deduction. If you are legitimately eligible to claim this credit, you claim that credit. It doesn't matter what people are saying the myths are. Just claiming the home office deduction alone is not going to trigger an audit. If it's yours to claim because you're rightfully eligible, go right ahead. Just make sure that you have the substantiation for it. So if you're doing the home office deduction, the square footage, anything that you're doing concerning that space, record it, document it, okay? Number 2, making too much or too little. Listen, make as much money as you want, make as little money as you want. That's not going to trigger an audit just by itself. The IRS is not going to say, oh, this person is making too much money or too little money. It's one of those things where you just want to make sure, again, you're documenting everything. And I have folks that say, well, filing an extension can trigger an audit. That is not the case. Filing an extension says, listen, I need more time to file my tax return. And in fact, the government encourages you to utilize that time so that you don't miss the deadline or file an inaccurate tax return. And that's when you're going to be looked at. All right. Now, rounding numbers is also another item that could also not trigger an audit, but it could. So this is one of those cases where, how do we want to play this? Having round numbers in and of itself may not trigger an audit, but if you have a lot of round numbers on your tax return, then the IRS may say, well, this is not likely the case, right? So when it comes on to how the IRS selects returns, they have a system that they call the discriminant information function, the DIF, and this is used to compare your tax return to the statistical norms. All right, so the higher your DIFs are, or your DIF score is, the higher your chance of being reviewed or being selected for an audit. So there are a few ways though that you can adhere to help to reduce your risk of an audit. And the first is going to be, make sure that you report all your income. Make sure that everything that is on those tax forms that you've received from an income perspective, you put it on the tax return. Don't leave anything accounted for. In fact, I also recommend that folks pull their wage and income transcript from the IRS's website. This way they can see what has been reflected against their social security number in the IRS's system. That way they can account for it accurately on their tax return. They don't miss anything. And then make sure you're not exaggerating on your deductions. This is a very painful area that could cost you a lot of money, okay? And then you want to make sure that you document everything. Keep receipts, any proof of expenses, keep them. I would recommend though that you keep them electronically rather than in a paper form, because those ink at some point they're going to go. Keep that electronically, right? And then make sure that you're filing on time and you're filing accurately as well. All right. And then lastly, if you are self-employed or you have a complex tax return, do not pull a DIY. This is not the time to do that. Make sure you find either an enrolled agent, a CPA, a tax attorney, someone with professional lens to look through what you have and point out what may be irregular based on what you're presenting or what the industry norm is. Right. Now, I know IRS audits, they're not random, right? They are usually triggered by inconsistency or abnormality. So what you want to do as a taxpayer is to just make sure that you're keeping accurate records as you're reporting it on your tax return, you're documenting everything, you're being honest, and that will help you to reduce your risk level of being audited. Now, if you found this video to be helpful, give it a thumbs up, subscribe. And if you have any questions, drop that in the comment section. I'm always here. Again, my name is Rose Brown, also known as the Accountant Therapist, and I am the CEO of Brown's Advisory and Accounting Firm. See you next time.